We're often asked the question, why would investors use an exchange-traded product? I think there are a number of reasons why investors look to use exchange-traded products in the UK market and other markets. First and foremost in the UK is the fact that they're traded free of stamp duty, so that's a huge benefit relative to buying shares where there's a 0.5% charge for share purchases. I think other reasons why exchange-traded products are attractive to investors are the fact that they provide easy and quick access to markets and that they're traded throughout the market day. So they're very flexible instruments. In other words, if you or I bought something at 3 in the afternoon and decided that we'd made a terrible mistake 5 minutes later, we could sell out of that position straight away. Now clearly, typically investors are not day trading exchange-traded products, rather they're looking to use them both for strategic and tactical purposes. At the margin, of course, there will be some people who use them for day trading purposes. And the reason that they're able to do that, of course, is that they are, as I said, very flexible instruments supported by multiple market makers, and that makes them attractive to investors. The fact that they don't go to a single entity to get a price, they get a price from the market, they can see the transparency around the product, the way it's constructed and the way in which it trades. So those are huge benefits to investors.
The reason why exchange-traded products should be considered is because they offer the ability to invest into an underlying asset class which normally wouldn't be available to an underlying client. And therefore it gives you diversification for your portfolio, looking at different asset classes such as commodities, fund indices, and notes.
If you look at commodities as an asset class, there are a number of reasons that make it particularly appealing to investors. I think first and foremost, commodities bring diversification benefits to a portfolio, and that's been clearly demonstrated by a number of academic studies. If we put that into context, it's got many dimensions. I mean, at the first dimension, you look at a broad commodity index, which is built up with agriculture commodities, industrial metals, precious metals, and energy. Well, there are two segments in there which are very much pro-cyclical, the energy and the industrial metals. There are two segments, or even three segments, that are potentially counter-cyclical. In other words, agriculture, precious metals, and livestock. So that means that the commodity index in and of itself is quite well diversified, and potentially, given the nature of commodities as being a discrete asset class, will give a different profile of returns from that get delivered by equities and bonds. And that's been well, as I said, documented by a range of academic studies. If we look at more specific situations, there can be contexts where there is a political development, a weather-related factor that affects a commodity, and so in those circumstances, exchange-traded products enable investors to take very specific and precise positions directly on a commodity where they believe that there is going to be some form of return that will be beneficial to their overall portfolio. And that's, I think, what makes commodities particularly interesting. It strips away the political, company and equity market risk associated with equities connected with commodities and gives the direct commodity exposure, which is ultimately what the investor is looking to express when they have a commodity view.